Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled Mortgage Class Actions in the COVID-19 Era and Related Considerations. My name is Debra Bogo-Ernst, and I'm a partner in Mayor Brown's Chicago office and a member of the Litigation and Dispute Resolution practice. I also co-lead our nationwide consumer and class action practice. I, along with others on our team, represent national and multinational corporations in a wide range of business sectors, with particular emphasis on the defense of commercial and consumer-based litigation and enforcement actions in the financial services industries. First, a couple of housekeeping items for you. As regular listeners to our calls will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session today, please send your question regarding our topic by email to G, F as in Frank, M as in Mary, @mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today is partner Lucia Nale, with whom I have worked for over 20 years. We have 50-plus years of mortgage-related litigation and investigations experience between us. Boy, has that time gone by quickly, Lucia. Would you like to say a few words about what you do?
Sure. Thank you, Debra. And yes, it indeed has gone by quickly. Hello, everyone. My name is Lucia Nale, and I'm a 32-year-plus litigation partner in Mayor Brown's Chicago office. I am a member of Mayor Brown's firm-wide governing partnership board, and I founded and head the firm's financial services litigation and consumer and class action practices. I focus on complex commercial and civil litigation, class actions, and enforcement and investigation matters, with a particular emphasis on the defense of financial institutions in the consumer and retail financial services industry.
With those brief introductions, we will now begin today's discussion. And this is Debra again. As I mentioned, our presentation is called Mortgage Class Actions in the COVID-19 Era and Related Considerations. I will start our discussion today with a focus on COVID forbearance and credit reporting issues. Lucia will then turn to the Fair Debt Collection Practices Act, the new regime at the Consumer Financial Protection Bureau, and other trends to watch. Let's focus now on COVID forbearance and the related litigation that we've seen in 2020 and that we expect to see in 2021. For those of you who lived through the last financial crisis, you may be having deja vu. For example, does this sound familiar to you? Quickly implemented government program designed to keep people in their homes, a lack of guidance from the government and inadequate notice about the program, lack potentially of resources and training available to mortgage servicing employees given the very quick announcement by the government, and also a high demand by the borrower population at large for mortgage relief, potentially miscommunication between borrowers and servicers related to things like approvals for loan modifications. There could be some ambiguous contracts given the speed at which the government implemented the program, and there could be credit-related reporting issues. So if all of that sounds familiar to you, you may be remembering the Home Affordable Modification Program, or HAMP, which was announced in early 2009. And at that point, the servicers were expected to take quick action to keep borrowers in their home. So what happened and what lessons did we learn from back then? Well, despite no private right of action, class actions and individual lawsuits popped up all over the country. They alleged things like breach of contract, UDAP issues, credit reporting concerns, alleged violation of good faith and fair dealing clauses in mortgages, etc. Although everyone had great intentions, the situation became frankly a mess, and some of it is still ongoing over 10 years later. Now, if you fast forward to today and COVID-related forbearance, this is where the deja vu really kicks in. You have the government announcing available forbearance plans in March of 2020. And once again, the government put pressure on mortgage servicers to act as quickly as possible to implement a program designed to assist borrowers in retaining their homes. Specifically, COVID-related forbearance was available for borrowers with federally backed mortgages and is still available at this moment. Borrowers have the right to request and obtain forbearance for up to 180 days and to request and obtain an extension for another 180 days for a total of 360 days or almost a year. So as of December 2020, 2.7 million borrowers have sought payment relief options and enrolled in CARES Act-related forbearances. According to the CFPB in a supervisory highlights issued just a couple weeks ago in January of 2021, just like with HAMP, servicers face difficult challenges with COVID-related forbearances. Servicers had to quickly implement the CARES Act and make other operational changes in light of evolving investor guidance. Many servicers reported operational constraints, resource burdens, and service interruptions. Servicers often moved employees from other duties to respond to the very large volume of forbearance requests. And as a result, the CFPB observed some problems given this quick implementation of the forbearance program under the CARES Act. For example, servicers provided incomplete or inaccurate information to consumers about forbearance. Some borrowers, for example, were told that only delinquent borrowers could qualify for a CARES Act forbearance, which is simply not true. Other written materials could have provided inaccurate information to borrowers, or what the CFPB observed was that certain servicers were requiring a signature as a condition of a COVID forbearance, and that was not appropriate. Another thing that the CFPB observed, and you can find all of these observations in the supervisory highlights that I mentioned from January of 2021, the observation was that servicers sent unwarranted collection and default notices, assessed inappropriate late fees, and initiated foreclosures for borrowers enrolled in forbearance. In addition, the CFPB observed that servicers canceled or provided inaccurate information about pre-authorized electronic funds transfers. They failed to timely process forbearance requests. They enrolled borrowers in automatic or unwanted forbearances and observed loss mitigation process deficiencies. This is a pretty detailed finding from the CFPB, and you can bet that this will be at the top of the CFPB's mind when they are thinking about their supervisory responsibility and potential enforcement actions. Following the release of the supervisory highlights outlining these issues, the acting director of the CFPB stated just last Thursday, on January 28, in released remarks that the problems I've outlined for you are just a few examples that show the types of harms consumers are suffering and the meaningful impact that strong oversight could have on the country's recovery effort. Moving forward, the CFPB will take aggressive action to ensure that regulated companies follow the law and meet their obligations to assist consumers during the COVID-19 pandemic. So servicers can expect that this will be at the top of the CFPB's mind as it's moving forward in determining enforcement actions and the like. So in addition, the CFPB is not the only one with these observations. As you might suspect, the plaintiffs' bar is taking note and filing lawsuits. What we've seen so far is litigation reminiscent of the 2008 financial crisis and the mortgage and loss mitigation litigation that ensued there. So we have seen class action litigation alleging that the mortgage servicer failed to adhere to the CARES Act requirements or otherwise failed to properly implement the forbearance. For example, there have been lawsuits involving claims of failure to provide a 180-day forbearance plan and instead offering forbearance plans in only 90-day or fewer increments. We have seen other lawsuits about servicers requiring borrowers to make or document particular certifications about their need for a forbearance plan, and that is not appropriate under the CARES Act. We've seen lawsuits about asking borrowers to sign and return a written forbearance plan, which is not a requirement to get a forbearance. We have seen class action litigation concerning purportedly forced forbearance plans, where you're actually putting a borrower into a forbearance plan without their consent. And we have seen litigation challenging compliance with state and local forbearance requirements as well. So while there is no private right of action under the CARES Act, just like there was not with HAMP, the suits that we're seeing today rely on various state law theories. For example, the theories include fraud and unfair business practices, individual wrongful foreclosure claims, credit reporting claims, which I'll get into in just a minute. And going forward, we expect to see this litigation and even more as forbearance periods end and are not further extended. For example, according to an article I read just this morning, forbearance is scheduled to end for over 600,000 delinquent mortgages in April of 2021, according to Black Knight. And that, of course, assumes there are no further extensions for those folks. So we should expect to see breach of contract actions, consumer protection or unfair and deceptive trade practices claims, fraud or negligent misrepresentation, wrongful foreclosure, potentially alleged violations of state laws protecting homeowners in danger of foreclosure, RESPA inquiries and related litigation, Fair Debt Collection Practices Act claims, which Lucia will cover shortly, issues with loan modifications following forbearance plans, potentially government investigations and inquiries, and claims under the Fair Credit Reporting Act. And on that last point, litigation about credit reporting related to COVID forbearance plans will be particularly active. We expect issues to arise similar to those that arose during the HAMP program with respect to credit reporting. Section 4021 of the CARES Act mandates creditors to report any account that has a payment accommodation on it as current, so long as the account was current when the accommodation was requested. If a borrower heads into a forbearance as delinquent on their mortgage, the servicer must maintain the delinquent status while the accommodation or forbearance is in effect. If the borrower brings the account current during the forbearance period, the servicer must report the mortgage as current. The rules get more complicated once the forbearance plan ends, as servicers cannot switch from reporting a borrower as current during the forbearance plan to immediately delinquent post-forbearance if the borrower makes timely payments while in the forbearance plan. In addition, there is uncertainty in the relevant guidance as to how to address post-forbearance defaults that are not cured. This whole situation is potentially confusing to servicers and borrowers alike, and to the extent servicers report borrowers' forbearance circumstances in an inappropriate way that impacts borrowers' credit scores, borrowers will file lawsuits. So litigation related to credit reporting in the mortgage forbearance context is certainly something to keep top of mind. So with all of that in mind, I will turn the virtual podium over to Lucia Nale, who will start with the Fair Debt Collection Practices Act and what to expect in that arena.
Great. Thank you, Debra. Well, apart from the COVID-related concerns that Debra mentioned, particularly as it relates to the Fair Debt Collection Practices Act, I think that we're going to see a ton of more activity across the board in that realm. As most folks are aware, the CFPB issued its long-awaited final debt collection rule, Regulation F. It was issued in two sets, one on October 30th and the other on December 18th of 2020. And the regulation aims to restate and clarify the Act's prohibitions on harassment and abuse, false or misleading representations, and unfair debt collection practices, and it also addresses disclosure and safe harbor requirements. The final rule is a major development, and we believe it's going to have a direct impact on enforcement investigations, supervisory examinations, and litigation. Although the rule does not become effective until November 30th of 2021, it does represent the CFPB's interpretation of the FDCPA. As such, we expect courts and litigants alike to incorporate Regulation F's thinking into the claims and rulings. Along the same lines, we expect a very active CFPB supervision and examination activity, particularly with the new Biden administration and with the anticipated new director for the CFPB with the nominee, Mr. Rohit Chopra. In November of 2020, Mr. Chopra, who is the current FTC commissioner, issued a statement regarding the FTC's enforcement action against a debt collector. Among other things, Mr. Chopra noted that in FTC enforcements, in his view, victims of debt collection abuse frequently receive only a minuscule portion of their losses, if anything at all. He also noted that to stop such abuses, the FTC should coordinate with the CFPB in joint actions to help make victims whole through access to the CFPB's Civil Penalty Fund and to reduce duplicative agency efforts. And he also highlighted the overall need to do more to redress consumer injuries and stop abusive practices. So I think it's pretty fair to say that with the change coming over at the CFPB and some of the other things that we've read, that we're going to see some interesting developments on the FDCPA front. One development in particular that I want to point out that has less to do with the CFPB, and more so with Article 3, are some of the Article 3 standing developments that we're seeing having happened in the Seventh Circuit recently. In a series of 5 decisions issued in December of 2020, and these are the Larkin, Brunette, Gunn, Nettles, Spuler, and Bazile decisions, the Seventh Circuit clarified the requirements for having federal jurisdiction of an FDCPA claim. Among other things, the cases collectively hold that to have federal jurisdiction, an FDCPA plaintiff must plead facts showing that he or she suffered an injury in fact, which must be concrete and particularized and actual or imminent. Second, a bare procedural violation of the FDCPA without any accompanying injury does not give rise to federal jurisdiction. The case has also held that a plaintiff must allege a concrete injury regardless of whether the alleged violation is a substantive or procedural provision of the FDCPA. Allegations that a plaintiff was intimidated, confused, annoyed by a debt collector letter, or even retained a lawyer after receiving a letter are generally not sufficient to constitute an injury in fact, and the non-receipt of information to which a plaintiff may be entitled under the FDCPA only amounts to a concrete injury if it impairs the plaintiff's ability to use the information for a substantive purpose that the statute envisioned. Now you might be listening to this and going, well, I don't see what the problem is. From the Spokio perspective, that seems pretty good. Well, that Spokio is not the problem in terms of the development of the law on that front. The real problem is that it doesn't necessarily defeat the claims, but rather is likely to lead to more Illinois state court FDCPA litigation instead. The Seventh Circuit rulings suggest that in a removal motion to remand context where Article 3 standing is lacking, remand rather than dismissal for lack of standing is appropriate. And particularly given that the FDCPA provides for concurrent jurisdiction, Illinois, unfortunately, the state courts there, they're not obliged to follow federal standing requirements, and they do not impose an injury in fact requirement. So when you combine that together, coupled with the inability to have many of these statutory damage claims heard in the Seventh Circuit courts, I think what you're going to find is the obvious retort and increasing caseload in Illinois State Court on that front. I want to turn next to the CFPB because I think we've got a new regime with the appointment of the new director, Rohit Chopra. And, of course, no discussion of what to expect would be complete, of course, without addressing the CFPB. So with the new Biden administration and the recent appointment of the former FTC commissioner and former CFPB official, Mr. Chopra, as nominee as our next director of the agency, we think that change is coming to the CFPB, and we expect a much more active and aggressive CFPB. First, a little bit on Mr. Rohit Chopra's background. He's a graduate of Harvard University and the Wharton Business School. He spent some brief time at McKinsey & Company, and then he joined the CFPB as an assistant director and as its first student loan ombudsman when the agency first opened its doors in 2011. He's a protege of Elizabeth Warren. He has been at the Federal Trade Commission since 2018. He's one of 5 commissioners and one of only 2 Democrats at the FTC. At the FTC, he was quite outspoken in dissenting from various agency actions that, in his view, did not impose sufficiently severe penalties or ensure sufficient consumer redress. So as the sole director of the CFPB, with a deciding vote on matters of enforcement, regulation, and policy, he's obviously going to have a significant impact on where the CFPB goes. Now, it's unclear where the CFPB will go, but we do think there are some areas we are most likely to see some new focus and areas of concern. One area of Mr. Chopra's most likely priorities, we think, will be a refocusing on the agency's enforcement of fair lending laws. The CFPB has an Office of Fair Lending and Equal Opportunity. This Fair Lending Office is intended to provide oversight and enforcement of federal law to ensure fair, equitable, and non-discriminatory access to credit, including under the ACOA and HMDA. The Office of Fair Lending used to be part of the Division of Supervision, Enforcement, and Fair Lending, but under then Acting Director Mulvaney, he moved the Fair Lending Office out of Supervision and Enforcement Division to the Director's Office, where it became part of the Office of Equal Opportunity and Fairness, which itself did not have any enforcement role. So, not surprisingly, under the 3 years under Acting Director Mulvaney, the agency brought only 3 fair lending enforcement actions, 1 under ACOA, 2 under HMDA, and we saw a substantially decreased number of referrals from the CFPB to the Department of Justice. With the new administration and the heightened focus on issues of racial equity, it seems likely that the Fair Lending Office will once again become a critical voice in the agency's fair lending and enforcement supervisions. And so I think it's fair to say that we're going to have much heavier focus on fair lending examinations, a greater number of fair lending enforcement investigations, and most likely an increased number of referrals to the Department of Justice. Another area that we think is going to see some increased activity is the area of student lending. Between the time when he was at the CFPB and the FTC, Mr. Chopra served as special advisor to the Secretary of Education, where he sought to advance efforts to improve student loan servicing, reduce unnecessary defaults, and heighten enforcement. So given his background, the enormous size of the student debt, and the policy focus on student loan issues, we think that there's going to be significantly increased attention in this area. So we foresee more student loan examinations for institutions under the CFPB's jurisdiction and increased enforcement scrutiny on all aspects of the student debt life cycle. Of course, we're going to see increased attention also in the realm of mortgage servicing. The CFPB was literally born out of the financial crisis, and the mortgage market has long been a CFPB priority. With the pandemic, its impact on the economy, and the CARES Act, and the mortgage and credit reporting related provisions, I think it's going to most certainly remain a continued focus. We would expect Mr. Chopra to pursue aggressive supervision and enforcement in this area, and to continue to be an advocate of congressional and executive actions and efforts to help consumers. Enforcement, I think it's fair to say, will be aggressive. Given his dissents at the FTC, it seems likely that he would push for greater civil monetary penalties and more rigorous consumer redress and monetary remedies. So, and as part of all that, we also expect much more of a heavier overall focus on UDAP provisions in enforcement actions. One other trend to watch, while not necessarily mortgage related, is a development in the area of the California Consumer Privacy Act, which became effective January 1st, 2020. We have seen a couple of class actions that are seeking to challenge voluntary data sharing as an unauthorized disclosure. These actions are significant because the private right of action under the California Consumer Privacy Act is limited to when consumers' personal information is narrowly defined by the Act, is subject to an unauthorized access, theft, disclosure as a result of the business violation of either the duty to implement and maintain reasonable security procedures. So the plaintiff's bar seeking to hook into a private right of action has been pursuing a novel theory whereby they allege that the private right of action for data breach extends to a business's voluntary disclosure of data. And they are seeking, as part of that, to apply it to a broader range of personal information than is currently contemplated for the data breach provisions. So there have been a couple of recent class action cases on that. One is the Zoom case, and then the other one involved a company called Retail Equation. One of those matters, the issue has disappeared from the pleadings, but in the other one, it's currently in dispositive motion, and we may see some rulings coming out the first part of this year. Obviously, if they extend this provision to voluntary data disclosures, which we think is contrary to the purpose and intent of that provision, it could expose businesses to massive statutory damages ranging from $100 to $750 per customer per incident, plus actual damages, injunctive relief, and such other relief. So that'll just be something to keep an eye on to see how and if the law develops in that field. And from there, I'm going to turn it back over to Debra.
Thank you to our audience for tuning in today. A few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to G, F as in Frank, M as in Mary, @mayorbrown.com. Thank you again for your participation. You are all free to disconnect, and we appreciate you joining us today.